Hello, everybody, and welcome to this month's Grow Your Law Firm webinar on strategies for optimising your cash flow. My name is Matt Sleater. I'm the lawyer's accountant from FWO Chartered Accountants. So again, welcome to today's webinar. And as usual, just before we kick off, I'd like to get just a bit of a feel for who's attending today and just get a little bit of information. So first of all, just I'd like to know whether or not you've attended a Grow Your Law Firm webinar before. So if you can just click on a yes or a no and just give a bit of a feel for who's here. So just a couple more seconds on that one and move on. So thanks for that. So we've got a 45% newcomers today, and 55% have attended before. So again, for those of you who have attended our webinars before, thank you for returning. I hope you continue to get some value out of it. And for those of you who are new today, welcome. All of my previous webinars, going right back for years, can be accessed on our website, fwoca.com.au. Also, just in terms of who you are, if you mind just ticking the box that's appropriate, whether you're a principal, employed solicitor, practice manager, CEO, or other. Everything that we cover off today is going to be just as relevant for each and every person with the role that they play in the business. There'll be parts of it though that are very much focused on the principles of the business. So yeah, if we just close that poll down now, thank you. We've got 42% of people attending today are principals of firms, so welcome. 25% employed solicitors, 17% practice managers, CEOs, and 17% others. So thank you very much for that information. So now it's time to get into today's topic: strategies for optimising your cash flow. So what I see in firms all around the country is basically they leave their cash flow management to chance. They don't necessarily understand the role that banks play in funding your firm. They also don't understand that they do control and can control the cash flow from their normal operations. And most of the time, the cash flow outcomes that are achieved in firms is absolutely to do with how busy they are and their lack of systems and processes around ensuring that their cash flow needs are met. So just keen to get a bit of an understanding how you manage your cash flow in your practice. So, do you manage your cash flow week to week or month to month or in line with your strategic plan? My experience is that most people, when they focus on their cash flow, it's week to week and more so day to day, because they just let it happen and keep their fingers crossed and hope that the revenues will be there and that that'll turn into cash and there'll be enough to pay the bills. So look, thanks very much for your answers there. As I was expecting, out of the people who are attending today, 80% of you saying that you manage your cash flow week to week. And if you're doing week to week, I'm expecting that's day to day, and maybe another way of saying it is wages cycle to wages cycle. Month to month, that's a smaller percentage, but still not really the ability to go further out and say, well, okay, what are my cash flows going to be for these next 12 months or even beyond, to give yourself a good idea as to what sort of things you're able to plan and implement that you're going to need cash for. And I see there that absolutely nobody is managing their cash flow in line with their strategic plan. First of all, just hopeful that you have a strategic plan, but even if it's in relation to looking at what your dividend policy is, looking at making sure your taxes are paid on time, looking at how we make our loan repayments, and looking at whether or not we have money to invest back in the business and to fund our growth. All of those things, it's critically important that you work out how you're going to manage your cash to be able to achieve those strategic outcomes. So thank you very much for that. And one last question, and we'll move on from there. How stressful is your cash flow management in your firm? Cash at the end of the day is the lifeblood of your business, and if you don't have cash flow, then your business can't prosper, let alone even survive. So as I see with most firms that I work with and talk to, cash flow is a significantly stressful focus in their firms. We're seeing here just from the results that continues, that except for 7% of you've got excellent cash flow. Congratulations, well done. We've got about 2/3 of everyone listening today that cash flow is highly stressful within their firms, and about 30% there's moderate levels of stress. So look, at the end of the day, cash flow stress is caused by two things. One, not enough profit. Two, that your billings and collection processes don't align to your needs in your business. They are more focused on allowing your clients to do what they want. So what you've got to look at when you're focusing on improving your cash is you've got to focus on those two areas. One, profit. We're not going to spend any time today talking about profit, but you've also got to look at what your policies and procedures are, and then how you fund your business. So when you fund your business, you fund it from two different spots, and that's basically debt or equity. So debt is using someone else's money, equity is using your own money. So debt can come in the form of bank borrowings, which might be via a term loan. Often it's via an overdraft, and equity is your retained profits. So you make your profits. How much of it you keep after paying tax? That's what your equity is. So where most firms go wrong, they don't have that mix right. They rely on a very high percentage of their working capital to be funded via equity. They don't utilise appropriate levels of debt for their working capital that they carry that's tied up in their work in progress and debtors. So it's really important when you're looking at your cash flow strategy is you've got to think of what that mix is. What's the appropriate debt versus equity mix that we'll have in our business. But towards the end of this webinar, what I'm going to do is I'm going to show you some numbers. I'm going to show you the impact that changes to some of your core strategies and core focus around your debt to equity mix can have on implementing significant cash flow improvements within your business. So we're going to look at those two things separately. We're going to talk about debt and we're going to talk about your equity. So your equity basically is your profits. What profits are you keeping within the business? And how much of those profits are actually turning into cash, and how much of that is you're able to use in the business, and how much of that you're able to withdraw from the business. So we're going to cover off a little bit of that. So let's look at what impacts on your cash flow. Your level of billing, so how much you bill, when you bill, whether you bill enough, what you don't bill, so what's sitting in your work in progress, your client payments, so how often those clients pay you. Do they pay money into trust? Do they pay you within your 7-day terms? Do they pay you whenever they like? Are you carrying a very high percentage of deferred deferred settlement matters, like for family law, property settlement, or PI firm. The timing of when they pay you is critical to your cash flow. Another thing that's really important to understand is that what you do with your clients when you bill them and when they pay, you actually provide them with credit. So they don't have to pay you while you're doing the work usually. They might only pay you 30 days or 45 days or 60 days after you've issued them with an invoice. But when you look at your expenses, your wages, your rent, your leases, all of your other expenses, often there's no credit that's applied for that. So your wages, you pay them every week or every fortnight, and they've got to be paid. Your rent's actually paid, and leases, they're generally paid in advance. So your rent needs to be paid on the first of every month, for example. And most of your other expenses that you incur in your business are not provided to you via credit. Most of those are payable pretty much when due. Telephones is one example. We might get a couple of weeks there, but you don't get to really stretch them out. The majority of your expenses, anything more than a week or two. Your disbursements is another thing. So what's your policy around your disbursements? Do you get your clients to put your disbursements into trust? Do you fund your disbursements? What's the level of disbursements you carry? So, if you're running matters and you carry $100,000 worth of disbursements, and then because of the matters that you're running, those disbursements grow out to 150,000, then those disbursements, you're funding them from within the business. That's going to have a massive impact on your cash flow. What are your loan repayments to the bank? When do you pay your tax? Do we have more assets that we've got to purchase? For IT or a new coffee machine or whatever it might be. But you've got to pay for those things out of your cash flow. And usually the last thing for those principals that are attending today, usually the last thing that gets paid is our drawings. So how much we actually take out of the business after we've gone and paid tax and paid everyone else. So all of those things impact on your cash flow, and you've got to actually balance what are the priorities. And if you're looking at managing your cash flow week in, week out, day in, out, that's a really stressful thing to do because there's so many moving parts. So what you need to do is you actually need to step back and look at the systems and the processes that are in your business that actually impact on the timing of when cash comes in and when cash goes out. So what cash is coming in? What are those processes? What are those activities that we can actually implement to improve our cash into the business? These things are within your control, but generally most businesses don't have enough focus on them. Cash out, what are we paying out? And then the timing of those two things. So you've got to look at what those things are, or those activities are that you can change within your business that are going to produce a different outcome for you. So whenever I do any strategic planning for any of my clients, I focus on these key 3 rules. And if you've attended my webinars in the past, then you'll know that I keep coming back to these 3 things. And over the years, these have been the 3 fundamental tenets of any strategic planning, implementation, or action planning that I've used in my business and that I get my clients to implement. The first one is a serenity prayer, and for those of you who haven't heard it, it says, "Grant me the serenity to accept what I can't control, the courage to change what I can, and the wisdom to know the difference." When it comes to cash flow in your business, there's so much time that's being spent on chasing debtors, chasing people to pay, and that is really something that you cannot control. So what you should be focusing in on are those things that you can control. What are my rules? What are the rules around when we bill a client, how much we bill a client, how much goes into trust, when we stop work? What are all those rules that have a direct impact on the cash flow? Einstein's definition of incentives is the second of the strategic rules, and that is Einstein defined insanity as doing the same thing over and over again and expecting a different result. So if your cash flow, if you're managing it week by week, you've got to change your underlying systems and processes so that it produces a different result. Because after all, the structure that you have drives the behaviours in your business which produce the outcome. So if you have a very unstructured, loose debtor collection system happening in your firm with your clients, so they can pay you whenever they like, and you don't bill them on a timely basis, that's why you're going to have a behaviour that doesn't improve your cash flow. That's why you're going to continue to get a highly stressed week in, week out cash flow management system. Instead, get a more structured approach, get a really focused management system around what must be into trust, when must you bill, when must they pay, how debtors are collected. And the more structure you have around that and the more focus you have on that as a continuous activity in the business, the more your cash flow will improve, because the outcome changes the outcome is produced from a different behavior that structure causes. And lastly, the third rule is by focusing on the majority. The old Pareto principle, 80-20. Most of what happens in businesses is based on the squeaky wheel concept, where systems are built to quieten the minority and the majority just to get forgotten about. So let's have a look at that in a little bit more detail. So what is it that we can control in our businesses? From a cash in perspective, we can control the amount that we bill, when we bill it, and how clients pay. So what you need to do if you do anything after leaving this webinar is you need to go back and have a look at your policies and processes within your business around how much you bill and when you bill, and how clients must pay you. If you change one thing in your business, ensure that you implement a trust account policy. It's there to use, so use it. And make sure you're billing regularly. Interim bill clients. There's nothing to say you've got to bill at the end of a matter. Change it up so that you are focused on implementing actions that drive a completely different outcome for your business. When you look at cash out, the only things you can control that is what payments you make and when you make that. However, in saying that, if you can remember what I said about credit earlier, is that most of your payments aren't provided on credit terms. So you've got to pay your wages, you've got to pay your rent, you've got to pay all of those things. So you don't really have a great amount of control. So really the only thing that you can control in your business is when you bill, how much you bill, and how your clients' payment are required to pay you. And then you build your systems and processes in your business to align to that, and you implement them ruthlessly. After all, if you don't have cash, you can't survive. What else can you control? You can also control whether you use your money or the bank's money. So something that I often see in firms is they might be carrying big lumps of WIP and debtors. So WIP is the amount that of work that you've already done on client matters that you haven't billed, and debtors are the amounts that you've billed that you haven't yet paid. They haven't yet paid. So it's cash uncollected. Combined, it's called lockup. And what it is, it's the amount of cash that you've got locked up of revenue that you haven't yet either billed or collected. At the end of the day, it means money that's not in your bank. So what you can have a look at is, how do we fund? That's an asset. That's something that's money that you're going to get in the future. And how do we fund that? You've got to, when you buy any asset, you've got two things you can fund it out of. If you can recall, debt or equity. So if you've got your work in progress and you've got your debtors that are growing as your business is growing, and you're not getting the right funding strategy in there because you're paying more out in terms of those wages, you're paying more out in terms of disbursements, you're paying more out in terms of rent, and you're building your WIP and your debtors because it's not getting billed as quickly as you'd like. All of those costs got to get funded. And if you're not funding them out of debt, you only fund them out of your equity, out of your retained profits. You've got to pay tax on that. So you're going to get more stress created in your business around your cash flow. So the key is to get the balance right between how much do we fund via our overdraft and how much do we fund via our retained profits in line with our strategic plan. So those are the things that you can focus on around what you can control. Just to recap, we can control our policies and processes around cash in and cash out, and we can also control, despite what you might think, the amount of debt funding we have in our business to fund our assets and our retained profits funding. And I'll cover this off a little bit further, but banks will lend you money to fund your business, and that's how banks make money. Depending on the structure of your business, depending on your revenues, depending on your profitability, depending on a whole bunch of things. I have a lot of instances with clients where banks have funded those businesses purely just secured against the practice's assets without any other personal assets being provided and supported by limited guarantees. So those sort of funding is available out there. So it's just a matter of assessing whether or not you can access it. And I'm talking about the top four, the big four banks. I'm not talking about any other lenders that are out there. So we've got to understand that. If we look at what we can do differently, and this is a key thing, most of our systems and processes in the business are designed around the minority of people, the people who complain when it comes to paying bills. So if we apply Einstein's definition of insanity and we think about what are the things that we can do differently to get a different result, what we can do is we can set our rules of engagement with our clients so that they're for the benefit of the firm, not for our clients. At the end of the day, you guys are running businesses. You're working in businesses. And every business where there's somebody that's purchasing from it, those purchasers expect to pay. It's just that you don't be crystal clear on the rules of how they must pay you, and then you don't follow those rules. So even if in your cost agreements or in your disclosure agreements, you've said that we're going to bill you at the end of every month for the amount that we've got sitting in our work in progress, and you need to pay that within 7 days, or you need to have X amount of dollars continuously maintained in our trust account that we'll draw on and that you'll need to top up. Even though your contracts say that with clients, you don't implement them. So no wonder your clients won't follow suit. At the end of the day, you've got to get that cash out of their pocket into your pocket. They sign a contract, they will actually expect to pay you on time. It's usually your systems that let you down. And if we think about the majority, what are the majority of transactions that happen in the business? So the majority of transactions are our billing. So most clients pay their bills on time. So tighten that up. Reduce your terms. Look at your debtors collection processes. The majority of your clients say they'll pay on time, but if you have a focused, structured strategy around managing when they pay, trust account top-ups, all of those things, then focus on the majority of those transactions, because if you can get those guys paying a week earlier because they have to comply with your rules, then you get a whole week's extra cash flow coming into your bank account. It makes a huge difference if you're managing your cash flow week to week. And look at using your retained profits and using the bank. The majority of firms, the majority of firms don't have that mix right. The majority of transactions are either funded via out of your retained profits. So you can work out if we want to fund the majority of our cash flow from the bank or from retained profits. At the end of the day, we've got WIP and debtors sitting there and a minimal amount of funding attached to them. Then you're going to, at some point in time, as your WIP and debtors blow out a little bit for whatever reason, whether it's market driven or something's happened within your business, or clients just are slack at paying, you're going to feel that pressure. So understanding how much spare cash you've got in your business to fund your business and how much you need is critical to make sure that you are not having cash flow stress in your business. So at the end of the day, these are the key strategies that you need to be looking at to improve in your business. You need to maintain and increase billings. So the timing of your billings is essential. So when you bill, you take the work that you've done out of work in progress and put it into debtors. So the faster you can get it into debtors, the faster it can be collected. So your key strategies around maintaining and increasing your billings has got to come from reducing your WIP. Get as much of your WIP billed faster, as quickly as you can. Change those rules of engagement to determine the timing. And at the end of the day, your clients will do what you tell them to do. So long as you create the system, you educate them, you engage them on that basis, and then your systems follow those rules. And once it's into WIP, then look at your systems and processes for reducing your debtors. So that comes down to trust account policy, when we stop work. When you bill clients smaller amounts more regularly, they will generally pay it much more quickly. So leaving large debtors, large bills to land into debtors is actually going to work against you, because you're not going to get that cash into your bank account as quickly as you should be. Clients often struggle to do that. They already think you're expensive, so you may as well bill them appropriately, but spread it out over the period of the matter. It's your rules. You can determine whatever you want in terms of how they're going to pay you. You don't need to follow any industry norms. You have some rules that you've got to follow in terms of your cost agreements, and when you can access trust monies, and when you can do all those sort of things. But at the end of the day, set your rules based on what you can and can't do, and then implement. Now, from a funding point of view, I've mentioned that banks will lend you money. They will lend you money to fund your working capital. Now, working capital is basically your WIP and your debtors, and for those firms that carry large amounts of unbilled disbursements, they need to also think about how they fund those outlays, because they can sometimes fund those outlays over a period of time. So banks will lend you money, but they want to know that everything's working in your business. They want to know that you've got a good solid, they want to know you've got control over your systems and processes, because they know that you've got a strong, solid, recurring revenue basis in your business. People will continue to have conflict issues. They'll either need them resolved or prevented, and so as lawyers, you'll continue to be generating revenue. So it's a pretty safe bet for the banks, provided all of the underlying financial criteria stack up. And look, I'm not aligned to any bank, and I'm not a debt broker, but I do know that some of the big four banks have got professional services lending groups within their business, and have got policies written about how they will lend to lawyers. And some of those lending policies will provide a security limit for the firm up to 60% of the previous year's fees. There's a bunch of other criteria you've got to meet. But if you've got $1.5 million of fees, then they're going to be lending. They might lend you up to $900,000 in working capital funding, or for funding for growth strategies or acquisitions or whatever it might be in your business. And they're real numbers. They're not made up. I've restructured debt with these banks numerous times with clients to get their funding strategies right, so that they can either unlock some of their capital or get some spare room in their overdraft, so that they're not constantly having to rob Peter to pay Paul, just so that they don't go further into the red, and build that comfort strategy in their cash flow plan to minimise that stress. Banks are there to fund you. You've just got to make sure all the underlying strategies are right. So just let's have a look at some numbers now. So being an accountant, I just want to put all that into a bit of a numbers picture for you. So what I've got here is I've just got a very simple little funding, cash flow funding model that I use in looking at what's possible in firms and what their current funding arrangements are. And here's basically some data that I'll apply to most firms, and I'll just pluck some numbers out and pop that in here. But basically, we've got this first part. Oh, sorry, just start this. We've got this part of the screen there that's showing the profit and loss for the business. So as an example, in this firm, they had $3.6 million of professional fees and $210,000 of cost recovery. So their total revenue is $3.8 million. They got expenses of $2.65 million there, and make a profit of $1.15 million. They carry, in this firm, they carried $950,000 worth of debtors and $650,000 worth of WIP. So out of that $3.81 million worth of revenue, they carry about $1.6 million worth of work in progress and debtors or lockup that that is cash flow that's just sitting there waiting to come into the business, not yet billed and not yet collected. And interestingly, in this particular example, we can see here that lockup has grown from $1.39 million to $1.6 million this year. So this firm's probably also had a little bit of cash flow stress. And from a KPI perspective, we're looking at those debtors days and WIP days. So what it's saying is that out of that $3.81 million worth of debtors, 70 of an annual revenue, 77 days of that is sitting in debtors. 65 days of that is still sitting in WIP. So we've got combined there about 142 days of combined lockup of that revenue. So out of 365 days of this revenue, 142 days of that hasn't turned into cash. So this business will be feeling the pinch. If we look at some other financial aspects of their business too, though, so they've got every month they're paying $7,500 of repayments back to the bank. They also carry unbilled disbursements of $200,000, of which $190,000 was at the beginning of the year. They're billed out $220,000, but therefore they're paid $236,000. And there are other assets and liabilities that they're funded in the business. 200 fixed assets, they've got some loans there, overdrafts and so on. So when you look at this business, they're carrying $1.6 million worth of working capital assets. They've also got other assets of $200,000 of fixed assets and unbilled disbursements of $200,000, and their only debt that they're carrying in the business are these amounts here, totaling what's that, $290,000. So the majority of this business is being funded out of equity. So it's really these guys have had to work hard over the years to get all of their equity reinvested in the business to fund it. So let's look at what that means from a cash flow perspective for this firm. So if we look at the cash flows, and this is just basically taking the data from this core information, looking at how much cash has come into the business, how much cash has gone out of the business in terms of their expenses and their loan repayments and tax payments. So an average tax rate here of 38%. Look at how much they've had to, how much cash has had to be retained in the business to fund their growth. So this particular business, when you look at it, excluding GST, so assuming that your GST gets collected and paid, they've collected $3.848 million worth of cash. They've paid out $2.61 million of expenses. They've paid out $236,000 of disbursements. They paid out tax on that profit that they made. So that profit that they made, they've got to pay tax on that at 38%, $436,000. They haven't got an appropriate tax structure in place there, and they've paid $90,000 worth of loan repayments during the year. So out of all of that cash, what they've made in what cash they've got before they make any drawings during this year is only $475,000 worth of cash flow. So out of all of that money that's come in, there's only $475,000 that's left there to be paid out of a profit that they made of $1.15 million, 1159. Cash after tax, after repayments, 475. Ouch, that's got to hurt. Now this firm has 3 principles in it. So what that means is that the cash that's available to withdraw out of the business, assuming that they don't have any that they're not going to leave any of this money in the business, is $158,000. So these guys are turning over $3.8 million in revenue, and they're only pulling out cash of $158. Now, put to one side, one way of improving that cash flow is to improve their profitability by better recovery of their costs, labour costs and so on. But basically, if we focus on those 2 variables around maintaining our current amounts that we bill clients, but also getting that billing happening at a faster rate and getting that cash collected, if we were able to reduce our debtors days, so our debtors days here being 77 days and our WIP days being 65. So if we can reduce our total amount that's sitting in our debtors and our work in progress, then what that will turn into is additional revenue. So if we reduce, say, our debtors days by 20 days with some strong systems and processes around collecting our money first, then what that's going to do, it's going to reduce our debtors balance back to 57. So originally our debtors was at 950, but if we can cut 20 days out of that with some very focused, structured internal systems and processes, it brings that balance down to 692. But on top of that, if we could get, say, a 10-day improvement, and that 10-day improvement is from 65 days, then down to 55 days, then what that's going to do is it's going to take more of that revenue and put it into our profitability. So we're going to bill more, okay? So basically what dropping those days down does, it reduces our lockup. So now we're back here to, what's that, about 1.1, 1.2, $1.25 million roughly, where it has been reduced from 1.6 million there. So we've got improvement in our cash flow, but that comes from 2 different spots. First of all, it comes from improvement in revenue because we've got more revenue that we're going to be billing because we're billing more because we're not maintaining as much in WIP, and then we're collecting it faster. So it's going to turn into not just revenue improvement, but also cash flow improvement. So if we looked at that, at the net cash flow then that's available just by implementing that strategy, those strategies, small amount of revenue improvement, better collectability of the cash by tightening our systems, then our revenue that we get per principal's gone from 158,000 now out to 271,000. Profits are improved a little bit, but most of that is coming from faster collection. So faster billing, faster collection turns out an additional $112,000 per principal in this firm. So you're not really changing anything you're doing there. You're not changing pricing. You're not changing, you're not reducing any expenses. You're not increasing, finding new matters. All you're doing is implementing processes in your business around how you engage your clients and the rules of engagement around when you bill them and how they must pay you. And then you implement those and you live and breathe it, and that you don't have any you have minimal exceptions to that rule, and then you'll be able to get a much more predictable cash flow. So that's the first thing. Looking at your cash flow funding strategy, first thing, the low-hanging fruit is, what are our processes that we have around engagement, billing, collection, tighten those up, get a big focus on those, and they will reduce the amount that you carry in debtors, reduce the amount that you carry in WIP, and turn that into profits. But often practitioners in their firms are just so busy doing all the work. So get a shift away from that. Still do your work, but build systems and processes that focus in on this. So the next thing I want to do, and just to sort of wrap up today, is just have a look at what can also happen from a bank funding perspective. So if we look at this firm, if we look at their current funding position, they've got $2 million worth of assets. Excuse me, 950 of debtors, 650 of WIP, 200 of unbilled disbursements, and 200 of fixed assets. So you've got $2 million of assets that are there that they've funded in this business. And how have they funded it? They've funded it firstly via some debt, overdrafts of 50,000, bank loan of 150, assets finance for some of those fixed assets of 90,000, 290 grand. So out of that 2 million, they have funded retained profits after tax of $1.71 million. Now that's an after-tax amount because they've had to, these principals have had to pay tax on their profits to leave that money in the business to fund those assets. However, if you look at it from a pre-tax point of view, and remember we had back here that the tax payment here is 38 cents in the dollar on average for this particular business, that means they've had to generate $2.75 million of pre-tax profits, pay tax on it, to be able to fund that level of retained profits. However, our profitability for a year pre-tax is 1.159. So effectively over the life cycle of this business, they've had to retain probably about 2.3 complete years of profitability to fund this business. Just doesn't make sense. So if you look at their debt to equity ratio here, they're using 14.5% of their assets. They're funding via debt, 290, and 85.5%, 1710, is being funded via equity. So let's say we decided we wanted to change that funding model up a little bit in this business and say, okay, we've actually got a really good asset base here, and we've got some good profitability, we've got some good turnover. Let's have a look at changing up and changing the rules around our debt funding, because we're still running this model in this business that we had when we set up, where no one would give us a cent. So we'd had to eat what we killed, and hopefully there's a bit left over there to pay the wages next week. And usually that structure, the structure that I've outlined here, is what I see in firms. They're still running the same funding models that they had when they started their businesses up, except now they've funded $2 million worth of assets. So let's just, so what we've got here is, if we can just go back to our operating cash flow, if you can remember, down the bottom here, we had current cash flow per principal. They were getting $158,000, and they've also got additional cash flow now that they've created via the reduction in their lockup, better WIPs and debtor systems. So now we look at, well, what other additional capital or additional cash could we access by unlocking some of this capital that we've retained in the business? So we go to the bank. We say, okay, we're more comfortable to run now at, let's say, a 30% debt funding position. So out of our assets, we're no longer going to fund 14.5% of our 2 million. We're going to fund 30%. And what that would do is that would increase this $290,000 worth of liabilities here by another $310,000, so that the amount of liabilities would end up being $600,000. And we've got more than enough assets there. We're still only carrying 70% we're still carrying 70% in equity. So what that would do is that would then produce for each of the principals in the firm the ability to access additional cash of $103,000. Now, they might not want to draw that out, but what that might just do is it might just create a buffer in working capital, knowing that it's there, so we can go and fund that growth strategy. Or we want to go and acquire another small firm. Let's go and do that. Or we've got to do that fit out. You know, there's a whole bunch of things that inhibit progress in businesses because they can't fund the future cash flows for their strategies. So in this example, I'm just showing you that if you look at how you fund your business, you can unlock additional cash to be able to do that, because at the end of the day, you have already funded all of those assets. Either you might wish to take some of that capital off the table, it might be part of a super strategy or a retirement strategy, or you might want to be able to do it in a way that can restructure some non-deductible debt into deductible debt in your businesses. But that's all possible. But at the end of the day, if assuming that these particular principals of this firm decided they were going to withdraw that money from the business, then the cash that's available for them is then about $375,000, improved from $158,000. Now, remembering that this line here, improvement in lockup and your cash from unlocking equity, they are a once-off. So what you've got to keep doing to continuously improve your cash flow is grow your profitability, and then what you need to do also is continue to reduce your WIP and debtors days so that more of that cash is landing in the business. But from a funding perspective, just to give you a perspective, I mentioned before that some of the banks have got funding policies that are written for legal firms, and the banks that I know of that do that can have a lending limit of up to 60% of the previous year's fees. So if you look at whether or not a bank would lend you, provided there's a bunch of other things that stack up, it's not just saying go to the bank, they will lend you this money. You've still got to apply. You've still got to prove your cash flows in your business. You've still got to do all of those things. But on 60% of $3.6 million worth of revenue gives a maximum gearing limit of $2.16 million, which is actually more than the asset value of this business. Current debt's $290,000, so there's maximum additional debt that could be applied of 1.87. Whether the bank can lend you that much money, I don't think so, but it shows you that there's plenty of room within their policies that some of these banks have to say, yes, we can go and lend you some more money to fund your strategies within your business, whatever they might be. Those strategies might be succession strategies, where how you can fund new principals coming into a firm and retiring principals out of a firm. It might be how you can go and employ an additional person to generate more revenue. It might be that you need to hire some more administration staff. Generally don't like that, but maybe from a practice manager perspective, to be able to get all this sort of stuff implemented to fund that. So there's a whole bunch of reasons why you need to be focusing in on your cash flow. And hopefully this just gives you a little bit of an overview how to step away from managing your cash flow on a week-to-week basis, stepping back and saying, what are our strategic activities that we need to be implementing in the business, and strategically work out how we're going to fund our business. And most importantly, how are we going to have comfort and confidence that we're going to be able to fund our drawings so that we actually get paid for all of this hard work that we've been doing properly. So guys, that's basically the end of the webinar today. And as I've always put out there at the end of all of my webinars, for the first 5 people who email me now at matt@fwoca.com.au, we'll be able to take you through a process by just flicking me through at some stage, after we've had a bit of a chat, your financial statements, and we can have a look at how that model applies to your business and look at what some of the key strategies may be that you need to have implemented in your firm to improve your cash flow from your day-to-day operations, and looking at what your funding strategy is within your firm. At the end of the day, I bring everything back to the numbers. Being a chartered accountant, I work with a lot of firms up and down the east coast of Australia. with a heavy weighting in southeast Queensland and in Sydney. And often I see these are the core issues that these firms have, and that is getting your strategy in place from a cash flow perspective to make sure it suits your business, not the client, and then to make sure that you're getting the right funding mix in your business so that you're able to grow and or even just maintain without that stress of cash flow pressure. So thanks very much. If you're interested in taking me up on that offer, I'll just email me, matt@fwoca.com.au. I'll email you back and we'll get a time scheduled in to have a little bit of a chat, no obligation and free of charge. Keep an eye out for our next Grow Your Law Firm webinar, which will be happening over the next 4 to 6 weeks. And if there's anything that you would like to run by me, please feel free to contact me. Hop on the website, fwoca.com.au, and we've got a whole bunch of old webinars and articles and information there that may help you in your strategic activities within your business. So thank you very much.